we are going to learn about the short-term cost analysis. So let's begin with the various types of the short-term function. So let's begin with the actual cost. Actual cost refers to all those direct expenses which are to be incurred during the production of goods and services in a particular organization. These costs are actually measurable, identifiable, and also represents the actual outflow of the resources from the business operation. Actual costs are include all those expenses like labor, wages, raw materials, cost, rent, utilities, depreciation cost, or any other you can see direct expenses which are directly associated with the production of goods and services of a particular business operations. And that is actually called the actual cost. These costs are actually tangible and measurable, which are being always being recorded in the financial statements of a business organization. Let's begin with the next cost, that is the opportunity cost. Opportunity cost, on the other hand, it always represents the value of the best alternative option or option foregone when any particular course of action or in a course of measure has to be considered. It also reflects all those benefits that you could have gained from the next best alternative use of resources. It also such costs are not recorded in the financial statement because these costs are also known as an explicit cost, but implicit costs are actually related to the decision making, as the opportunity costs are not deals with the decision making process of a particular business organization. Let's take an example, a very simple example to understand the opportunity cost. If you choose to play a video game for an hour, that means the opportunity cost is that 1 hour that you can gain something from that hour while in the form of studying, reading, or doing something else. And that 1 hour is actually called an opportunity cost for that particular kid or an individual or a particular person. Let's consider another example to understand the opportunity cost. If a business decides to allocate its resources to produce product A, so the opportunity cost is a potential benefit or in the form of revenue, in the form of profits that could have been earned by producing the product B instead, or rather than product A. And that benefits, that revenue, that profit that has foregone, that actually called the opportunity cost. So it always reflects all those benefits that a particular business or an organization could have gained from the best next alternative use of resources, that actually that benefits that could have gained, that's called opportunity cost. Now we can come up to the next section, that is what is actual a difference between the actual cost and the opportunity cost. In terms of nature, actual costs are explicit and the measurable expenses which are incurred during the production of goods and services in a particular business organization. But opportunity costs are implicit, and of course it also represent the value or the benefit or the revenue or profit of the foregone alternative by a business organization. When in terms of the calculation, actual costs are calculated by summing up the expenses which are related to the labor, raw materials, utilities, other direct costs. In terms of opportunity cost, they are more, such costs are more subjective. It requires more and more you can say research while giving up the foregone benefits of the next best alternatives. But when we talk about the calculation part in actual cost, such costs are recorded in the financial statements of the business, but opportunity costs are not being recorded in the financial statement because such costs are more subjective to have a deep analysis about the benefits or the revenues that have you can say foregone for the of the best next alternatives in a particular business organization, which has to be considered for a you can say to more and more benefits. Now we can come up to the next type of cost that's called the explicit cost. Such cost refers to an immediate outflow of cash from the business are actually called the explicit cost. So in simple words, I could say it just refers to an immediate outflow of cash that such cost you can see the explicit cost. These costs are incurred or occurred during the production process or regular activities of the particular business. Explicit costs are incurred due to the full utilization of all those factors of production which are actually being used for finished products like capital, land, labor, technology, enterprises, etc. These costs are paid in the form of electricity, you can say rent, salary, wages, materials, to all other miscellaneous expenses, so that a particular product has to be come up in the particular market. Explicit costs are very easy to recognize because whatever the expenses has been incurred to form a particular product and whatever the factors of production will be used during the production of goods and services, that particular cost or the expenses are actually called the explicit cost. So it always keep up a track of all those costs which are incurred during the regular activities of the business in terms of cash. So keeping a record of the explicit cost is very important because it always helps in calculating the revenue, profits, cost control, and decision making process in a very you can say organized way. Next one, the next cost or the next one is implicit cost. Implicit cost, in other words, we can call up the economic cost, which does not deal with the outflow of cash from any particular business organization. Implicit cost is the value of sacrifice which is made by the company at the time of conducting any some course of action or any remedies or any measure that to be taken to gain something for the business operations. So if such cost occurred or arises, it could be when any asset is utilized as a factor of production instead of renting such factors to others, and that cost are actually called the implicit cost. So the cost which are utilized within the business organization, that and whatever the expenses or the sacrifice made by the company so that they can conduct any some you can say other action for its own business operation or for the benefits of the operation, such costs, such expenses are actually called the implicit cost, which are internal or within the organization. Implicit cost, it is not easy to measure because it cannot be incurred in a monetary terms. So only in estimations can be predictable, can be prepared during that particular course of time. These costs are not being reported, not even recorded in the books of accounts because we don't know at what point of time or what period of time what sacrifices has to be made by the company so that they can come up some better course of action for its own business operation. So that's why such costs are not reported or recorded in the books of accounts. Implicit cost is determined as they assist in a decision making process about any replacement of any asset or any repairing of a new asset, that exactly call, and when in a certain way or any point of time such cost arises, that becomes the implicit cost. These costs actually impact or influence the performances and the profitability of the business, organization, or company. So, few examples could be the salary of the proprietor or any interest you can say on the owner capital. This is a difference between the explicit and the implicit cost. So when we talk about the meaning, I already explained that what is exactly the explicit or implicit cost. In other words, I could say the implicit cost, the out of the pocket cost, because it refers to the outflow of the cash from the businesses. Implicit cost, it could be a imputed or the opportunity cost because it not being measurable, it not being recorded in the books of accounts or the financial statement. It's all about sacrificing something so that they can come up with the more and more better course of actions. Then we talk about determining the cost. Explicit cost can be determined very easily, but implicit cost does not have any track, does not record or report, and it not being easy to determine accurately or precisely. When we talk about the calculation of profit, explicit cost assists in calculating both accounting profit as well as the economic profit. But implicit cost is helps to calculate only the economic profit. That means the foregone benefits, so that from the next best alternatives. When we talk about the cash or on the basis of cash, explicit cost requires the outflow of cash from the entity, but implicit cost does not require any outflow of cash. Let's come to the next type of cost we call the accounting costs. Accounting costs are also called the explicit cost, which always refer to the actual monetary expenses which are to be incurred during the business activities or regular activities or any business operations. These costs are measurable and of course it is being recorded in the books of accounts of the business. Accounting costs such as the expenses like wages and salaries, you can say raw material cost, rent, utility, advertising, office administration cost, depreciation, any other cost which include the direct cash outflows, that such costs are actually called the accounting costs. These are explicit costs where the outflow of cash is always being into during the business activities or regular activities of the business, and that's why it becomes the tangible cost which can easily identifiable, which is easily quantifiable and easily tracked in the accounting reports. And that's why such cost, which known as the explicit cost, which directly deals with the monetary expenses or the outflow of the cash from of the business operation, that costs are called accounting costs. Now we can come up with the next type of cost, that is called the economic costs. Economic costs are more broader term than the accounting cost because it includes not only the explicit cost or it also includes the implicit cost. That means the combination of two main costs, that is explicit and the implicit. Economic cost refers the value of all those resources which is being used in the production process, whether they actually include any cash payments or not. Implicit cost, as we always talk about, the opportunity cost, which are also included in the economic cost. So when we talk about the explicit cost, we talk about the accounting cost. We can also talk about any other cost which refers to the outflow of cash, but the implicit cost refers to the opportunity cost, which also part of the economic cost. Economic cost also reflects the full control that how it utilizes the resources, considering the both the type of cost and what would be the potential benefits foregone in the alternative uses. Let's take an example to understand the economic cost. If a business owner decides to use their own building for their business rather than renting out that building, so the economic cost is of using the building includes not only the explicit cost like property taxes, any maintenance expenses, but also include the implicit cost of the rental income that could have been earned by leasing the building to another business. So implicit cost is refers to all those benefits which has been foregone by the company to gain an additional benefits from the best next alternatives uses. So that actually called the implicit cost, which also a part of economics cost. And in this example, it's all about to renting out that building so that the more and more rental income could be earned, and that's called the implicit cost, which is a part of economic cost. And of course the economic cost include both. So if any example which includes the both part of cost or a combination of the two types of cost, implicit and the explicit cost, that actually refers the economic costs. Now, what is the difference between the accounting cost and the economics cost? So these are the main basis of the differences of these two types of costs. So when we talk about the scope, accounting cost focus on the explicit monetary expenses which is incurred by the business, but is always limited to the cash outflows which are actually recorded in the financial statements of the business. But economic cost considered both implicit and the explicit cost, and it is more broader term than the accounting cost because it includes all those cost of resources which is being used during the process of any decision making by the company. Next, talk about the measurement. Accounting costs are directly measurable, quantifiable, identifiable, and it involves the actual. It includes the actual cash payments. But economic costs are more comprehensive. It requires a deep analysis, which refers to the two main types, and including the opportunity cost of the resources, which has employed in their alternatives or which have an alternative uses to get more and more revenues and benefits. But it is more subjective. It is more you can see subjective estimations which are not being measured, which is not easy to determine precisely. Next, we can talk about the recording. Accounting costs are explicitly recorded in the financial statements, and of course, these costs, accounting costs, are used for the external reports, for the external record, or any other external purposes, or like tax purposes. But economic costs are more comprehensive and more inclusive, which is very difficult to record or measure and show in the financial statements of the business because somehow it is more crucial for the internal decision making because opportunity cost is always look up to the best alternative for its own organization rather than focus to get the benefits from the others. So the next important part is the two main costs, controllable and the uncontrollable cost. So when we talk about the definition, controllable costs are those costs which could be changed according to the decisions and the need of the cost. Such costs are considered controllable cost. Uncontrollable costs are those costs which cannot be modified according to the business decision or according to the need of the situation or the business owner's preferences or needs. That type of cost becomes the uncontrollable cost. When we talk about the period or the span of time, in the short run, adjustment can be made in the controllable cost within a short period of time according to the needs and preferences of the business owners. But uncontrollable cost can be renegotiated in the long run. So that means in the short run it is uncontrollable, but in the long run it could be negotiated, it could be renegotiated so that somehow some cost could be controlled. Let's talk about the examples. Controllable cost includes all those direct expenses like direct labor, direct supply, donation, bonuses, any training and development, membership, any dues, any overhead. Overhead is also the another cost. It could be controlled, it could be managed according to the requirements of the organization. But when we talk about the examples of the uncontrollable cost, it could be rent, it could be the utilities, a share of the administrative overheads, or any of the insurance fees. So somehow it could not be controlled and it could be negotiated but in the long run purpose or period. Now we can come up the next type of cost, that is the out of pocket cost and the book costs. Out of pocket cost are all those expenses which is paid directly by the individual or business for some goods or buying of goods or services which can be easily recorded or reported in the financial or the books of accounts or statements. It also, for you, for examples, include the wages, salaries, any direct payments to any other vendors, dealers for the goods and services. So out of the pocket costs are considered the explicit cost because they are deals with the cash payments or the actual monetary expenses because because they are directly paid and recorded in the books of accounts, and that's why such costs are called out of pocket costs. But in another type of cost which is called the book cost are all those expenses recorded in the accounting books like depreciation, honors funds, but it may not, sometimes it may not involve an immediate cash payment like depreciation, any interest on the owner's funds or the salary of the manager, which is not being paid in cash. So it may not be recorded on an immediate basis. So book costs are also often considered the implicit cost because they are not directly paid. They are not always recorded in the books of accounts or accounting books, and that's why it becomes the book cost. So it cannot it will be recorded in the accounting books like in the form of the additional you can say indirect expenses like depreciation, honors funds, which is not directly involved in cash payments. Now we can come up to the next cost, that is past cost. In other words, we can call the historical and the sunk cost. In other words, past cost are the expenses which have already been incurred, which cannot be changed because these are not relevant for the future decision making process because they are already incurred in the past time or in the past period. So a few examples to understand these called the cost of purchasing a machinery. So if you buy a machinery and that would be the current price, but of course you can also compare with the past price where the people have already purchased the same type of machinery. So that type of cost, when you're looking up, that cost becomes the past cost. The salary paid to the employees last year, the money spent on the failed project during the you can say last few months. So it becomes the past cost. So past costs are used for the accounting process, for the record reporting purposes, and any historical financial performances to measure, to understand the changes over the period of time in for the present or for the future based on the past figures or the cost. Now we can come up with the next cost is the future costs. Future costs are also refers the expected and the prospective cost. Future costs are expenses which are expected to be incurred in the future, which is being subject or leads to the manageable control and planning. It is such costs are very crucial for the decision making process, for to prepare the budgets, to forecast, and for the any of the scenario planning for the future. The projected cost of a new product, new project launch, and what would be the estimated cost of the equipments, upgradation, or it's all about any of the planned salaries for the next fiscal years, and what would be the budget for the coming year that comes under the future cost. So future costs are used for budgeting, for let's take an example, annual budget, forecasting, strategies, planning, making decisions about the investments of the new projects, any of the new operations of the business, and when any of the business organization or analyst will try to find out the any of the planned cost or you can say estimated cost in the future, that exactly called the future cost. Now we can come up to the historical cost. Historical cost are refers to the original cost of acquiring an asset. It is a value of an asset when it's first purchased, including whatever the cost involved in it, and bring it to its present value. This method is actually used in the financial statement so that to determine the actual book value of an asset. It is also used in the various situations where the asset is expected to be in process for a long time, like in case of the fixed assets like buildings and equipment, so that the depreciation would be charged on the book value. So one of the main advantage of using this cost is that it is a very straightforward, a very convenient and easy method to understand and directly apply in the accounting books. But as every cost have a limitation, so the one main limitation of the historical cost that it does not take into account any changes in the market value of any asset over the period of time. So as the book value of an asset may not reflect the current market value, and that's why one of the limitation is does not consider any changes in the market value of any asset. So because it does not you can say reveal what would be the significant changes in the market conditions. So that's why it leads to an inaccuracy in the financial reporting and decision making process. Now we can come up with the next cost is replacement cost. Replacement cost is the cost which replace an asset with a similar asset or similar one. So it is an amount of money which could be required to purchase a new asset in an exchange of an old asset. And that cost, whatever the cost you can say incurred in replacing an asset, then that cost becomes the replacement cost. So this method of valuing assets is used in the marriage situation where the asset is expected to be replaced frequently, or where the market value of an asset it leads to a fluctuations. But the point is the replacement cost always occurs when any of the company is expecting to replace an asset in on a frequent basis. One of the main advantage of the replacement cost is that it reflects the current market value of an asset, but the historical cost doesn't reflect any market value. But the replacement cost reflects the market value of an asset because it gives you the accurate measurements of the economic value of an asset, which include the implicit and the explicit costs, which are very useful and crucial for the decision making process in a particular business organization. But hence, one of the main limitation of the replacement cost, it could be, it can be a subjective when the value of an asset is based on the opinion of the experts, or any suggestions. So at that point of time, it becomes the limitation when the cost has been identified based on the opinions of the experts, and that becomes the one of the limitation of the replacement cost. Now we can come up with the next cost, that is the private cost. So when we talk about the private costs are those costs which are incurred by the individuals or the firms, or which are directly involved or into a process of any of the economic activities. So it is a cost of producing a good and service which are being borne solely by the producer or the consumer. So if a consumer buy, or you can a good and paid a certain price for that good, it becomes the private cost for that particular individual, and that's become the private cost. A few examples which has been shown on this slide are farm expenses on raw materials, labor, machinery, and the private cost of the production. For consumers, if the consumer has paid a price for a particular good or service, it becomes the private cost for that particular consumer because they are incurred to consume that product. Relevancy, the private costs are the primary cost that a particular decision makers consider while determining any profitability or profits of a, you can say whether they have to earn a profit or not on that particular product, or affordability in engaging in a particular transaction. Now we can come up with the next cost is the social cost. Social costs are also known as the total cost of the economic activity, which includes both private cost or any external cost, or you can say any negative aspects which influence the third parties, which is not directly involved in the activities as well, and that's become the social cost. Social cost reflects the broader aspect of the activities on the society as a whole. It's not only talk about the private cost, the private benefits, but it also refers to the activities which are totally belongs to the welfare of the society, and whatever the cost involved for for any of the activities that belongs to society as a whole, that becomes the social cost. Let's take an examples in a factory. Private cost of production includes wages and materials, but if the factory pollutes the environment, the cost of cleaning up the pollution or health effects on nearby resident are the external cost. So the social cost of production is the summation of the factory private cost or the external cost of pollution. So that means the social cost is not only involves the private, but also includes the external cost which influence any nearby residents or the people who reside near the factory, and that becomes the external cost, and it involves in social cost. Let's take another example to understand the social cost. In transportation, the private cost of driving a car is a cost of fuel and maintenance. But the social cost is also includes the additional factors like traffic congestion, road wear, pollution, which are borne by others. And that's why Such external cost is becomes and including the private cost becomes the social cost. Definitely external costs which are not directly involved in the activity of the business, but somehow it influences the you can say the third parties like the nearby people who are residing or the people who are facing any issues during the transportation period, and that's become the external cost. So when the private cost and the external cost will be added, it becomes the social cost. Now we can come up to the next cost is relevant cost and the irrelevant cost. Relevant costs are those expenses which are directly influenced by the specific management decisions makers, but the irrelevant costs are not affected by any of the management decisions. So relevant costs are crucial for the management decision process because it could be avoidable, and avoidable costs are also related to that decisions. But irrelevant costs are called the sunk costs also, which are not helpful in any of the decision making process because they are unavoidable options available to the business organizations. So these are relevant costs are the costs which totally depends on the decisions made by the management or organization, and these are avoidable or incremental costs which directly impact the decision or influence the decisions of the organization. Let's take an example of the relevant cost. If a company considers of producing a new product, the cost of material, labor, and other direct costs associated with that production would be the relevant cost because it could be avoidable, it could be the measurable, and it is always influence the decision, and that becomes the relevant cost. Irrelevant cost is doesn't affect of any of the decision. They are fixed. They are sunk cost, which would be incurred according to the whatever the option or the course of action is to be consider. Let's take an example. The depreciation of existing equipment or the cost of previously purchased raw materials could be the irrelevant cost if the company is deciding whether to produce a new product or not. Examples of the irrelevant costs are the sunk cost, which cannot be recovered, committed costs, which are locked in and cannot be avoided. Overheads are the fixed cost, which will continue regardless if it doesn't follow up any decisions. Let's talk about the distinguish between the relevant and the irrelevant decisions. The importance of why there is a need to distinguish between these two costs. Accurate decision making, it ignores the irrelevant cost and focus on relevant cost, which helps to make impactful decisions. Avoidance of the misleading information, of course, the irrelevant cost leads to the poorer decisions. Efficiency, ignoring irrelevant data saves time and effort in analysis process of launch of any of the new product decisions. Now we can come up to the next cost is sunk cost and the incremental cost. Sunk costs are the past expenditure which cannot be recovered, but incremental costs are the additional cost incurred while making up specific decisions by the organization. Sunk costs are actually irrelevant costs due for the future decisions, but incremental costs are the more crucial ones so that the financial performances or the choices could be easily evaluated. We take up an example that if you buy a non-refundable concert ticket for $150, that money is called a sunk cost because cannot be recovered. So the cost which cannot be recovered, it becomes the sunk cost. But the cost or any other cost, you can say recovered, or any additional cost incurred while making our best decision, it becomes the incremental cost. Whether you attend the concern or not, $150 already spent. Sunk costs are irrelevant to the future decisions, but it does not influence the choices whether to continue or to wind up the project. So that would be the example in case of the sunk cost. Incremental costs are the additional cost when you're making up or a business is making up any special decisions such as producing more units or engage into a new project. So let's take an example. If a company decides to hire any more employees to increase the production, so the additional labor cost becomes the incremental cost. Of course, incremental costs are very much crucial for evaluating the financial performances of the organizations or the financial implications of different decisions taken or considered by the organization. And they helps to determine if the benefits of any decisions is outweigh or exclude the cost or not. So this is the difference between the sunk cost and incremental cost. Time frame is the past expenditure and the future cost which are associated with the decision. Recover sunk cost is a irrecoverable. Relevant incremental is relevant to the decision making process. Decision making its sunk cost is irrelevant. Incremental costs are relevant. Example, the cost of non-refundable concern ticket or investment in a new project. That would be an example of a sunk cost, or in case of the incremental cost, cost of hiring more employees, cost of investing on a research and development for a new project, cost of producing an additional units of production, any fuel cost which for deliveries, it becomes the incremental cost because after any additional cost incurred during any decision making processes, it becomes the incremental costs. Now we can come up to the next type of cost, direct and indirect cost. So direct costs are easily tracked to a specific project, product or activity. Indirect cost cannot be easily tracked or estimated to a specific product, project or any of the activities. Direct costs are incurred directly and it mainly for the production of goods or services. But indirect cost it refers to the overall operations of the business or organization. Examples could be the raw material or the labor or the expenses which are directly used in the production of goods and services or any of the equipment which belongs to any specific project. But indirect cost includes the rent of the building, utilities used in that building, administrative expenses, advertising expenses, any salaries, any journal supplies into a buildings or land, that becomes the indirect cost. Direct cost can be directly allocated to the cost object or cost center or the service centers. Indirect costs are allocated using any of the allocation methods like cost drivers or allocation basis. It totally becomes it could become change in nature and depending upon the level of production or activity in case of direct cost. Indirect cost can be fixed or variable and it may not belong any changes or it become change with the changes in the production levels. Direct costs are essential in calculating the cost of goods sold and to determine the profit. Indirect costs are crucial for determining the overhead cost and the overall profitability of a business. Direct costs track and manage the Direct cost can track and manage the cost, which is very straightforward, estimated, and becomes less complex. Indirect cost can be tracked, can allocate indirect cost, but it requires a careful analysis and allocation techniques like cost drivers, allocation basis, etc. Now we can talk about the short run costs. The first one is the total cost, second one is the average cost, third one is the marginal cost. Total cost refers to all those costs include fixed cost, variable cost like rent, raw materials, which are actually deals with producing a certain level of output. Average cost is known as the average total cost. It is refers to a total cost divided by the quantities of output or the number of units. It represents the per unit cost of production at any given level of output. Marginal cost, it is a cost of producing an additional unit of output. It becomes the marginal cost. It is a change in the total cost when the production increases by 1 unit or by an additional unit. It becomes the marginal cost. Now we can come up what is the difference between the total cost, average cost, and the marginal cost. Total cost represents the overall cost to produce a specific quantity of output. Average cost provides the cost per unit of output. That means the total cost divided by the quantity of output. It becomes the average total cost or average cost. Marginal cost focus on the cost of producing one more additional output or units of output. Calculation part is the total cost is obtained by adding up the fixed cost and the variable cost for a given level of production. But the average cost is calculated by dividing the total cost by the quantity of output or the number of units. Marginal cost is determined by the change in total cost resulting from producing any additional unit or additional unit of output. Information provided or on the basis of information provided, total cost provides an aggregate measurement of the cost incurred. Average cost provides any deep insight into the average cost, that means the per unit of output. Marginal cost provides the information on the additional unit by producing each additional unit of output. Now we can come up to the short run cost functions. The first one is total cost. How to calculate the total cost? It refers to a combination or the summing up of fixed cost and the variable cost. Total cost represents the total cost of producing a given level of output, including both costs. Fixed cost. Fixed cost is a cost which does not change with the level of output in the short run, like rent, salaries, utilities, insurance, etc. Variable cost is a cost that changes with the level of output in the short run, like raw material, labors, utilities, any direct expenses, etc. Now the next concept is average total cost. So the formula which is how to calculate the average total cost is the total cost by the quantity of output. That means it refers to a total cost per unit of output. Because when we need to calculate any average of any cost, it refers to a per unit of output. Next one is average fixed cost. Average fixed cost is refers to the fixed cost or the total fixed cost by the quantity of output. It means it refers to the fixed cost per unit of output. Average variable cost is equal to the total variable cost or variable cost by quantity of output. It is refers to a variable cost per unit of output. Marginal cost. Marginal cost is a change in total cost when an additional unit of output is going to be produced. So this is an hypothetical, you can say, firm where the you can say the short run cost schedule has been prepared using up all the type of cost, or you can say the short run cost function. So the output has been given, which is keep on increasing from 0 to 10. Total fixed cost is also given, that is 60 of each level of unit. Total variable cost is given where the amount is going up to the 0, 30, 49, 65, 80, and so on. Now you need to calculate the total cost, marginal cost, average fixed cost, average variable cost, and average total cost. So if you are aware about the formulas that how to calculate these costs, that could be summing up in the earlier slides. The formulas has already been given. So the total cost is refers to the total fixed cost and the total variable cost. That means fixed cost plus variable cost, it becomes total cost. So once you add the total fixed cost and the total variable cost, you can come up to with the total cost. So 60 plus 0, 60, 60 plus 30, 90, 60 plus 49, 109, 60 plus 65, 125, 60 plus 80, 140, and so on. Now we need to calculate the marginal cost. So marginal cost is a difference between the total cost of the present unit and total cost of the previous unit. So when we talk about the level of output is 0 and the total cost is 60, and there is no earlier any previous unit which has been produced, that means the marginal cost becomes nil. But at one level of output, the total cost is 90. So the present level of at the present level of output, that is 1, the total cost is 90, and the previous level of output, that is 0, where the total cost is 60. So that means the marginal cost is the 90 minus 60, it becomes 30. So say when at the present level of output is 2 and the previous level output is 1, and what would be the total cost is 109 and 90. So marginal, how to calculate the marginal cost? It's 109 minus 90, it becomes 19. 120, and now we need to calculate the third level of output marginal cost. So 125 is the total cost, and what would be the previous unit? It's 109. 125 minus 109, it becomes 16. That would be the marginal cost. Same at the fourth level of output, the total cost is 140. And what would be the previous unit? That is previous cost of total cost, that is 125. So 140 minus 125, it becomes 15, and so on. Now we need to calculate the average fixed cost. So the average fixed cost is total fixed cost divided by level of output. So if you check on the fixed cost is 60 and you divide the each level of output from 0 to 10, the level of we can easily calculate the average fixed unit. That means refers to a fixed cost per unit of output. That means 60 divided by 1, 60, 60 divided by 2, 30, 60 divided by 3, 20, 60 divided by 4, 15, 60 divided by 5 is 12, and so on. Now we need to calculate the average variable cost. Now how to calculate the average variable cost? The formula is total variable cost by level of output. So that means 30 divided by 1, 30. 49 divided by 2, it becomes 24.50. 65 divided by 3, it's 21.67. 60 divided by 4, it becomes 20. 60 divided by 5, it becomes 20. 60 divided by 6, It's we continue here. Average variable cost is equal to total variable cost. That means 30 divided by 1 is 30. 49 divided by 2 is 24.50. 65 divided by 3 is 21.67. 80 divided by 4 it's 20. 100 divided by 5 is 20, and so on. So next is we need to calculate the average total cost. It means this average total cost is equal to the average fixed cost plus average variable cost. So you will easily calculate the average total cost. So average fixed cost is 60 for the zero level of for the first level of output, and average variable cost is 30. So 60 plus 30 is 90. 30 plus 24.50, it becomes 54.50. 20 plus 21.67, it becomes 41.67. 15.00 plus 20.00, it becomes 35. 12 plus 20, it becomes 32, and so on. So this is how we need to calculate the short run cost, giving up the level of output, and total fixed cost, total variable cost is also available, and accordingly you need to calculate the total cost, marginal cost, average fixed cost, average variable cost, and average total cost. So this is a relationship between the total cost, total variable cost, and total fixed cost. So as you are more aware that the total cost is equal to the total variable cost and total fixed cost. So if you look up the total fixed cost, it becomes horizontal and touched with the x-axis, and from the x where the total fixed cost begin from the y-axis, from there, from that point of origin, that point of the beginning of the total fixed cost, the total cost curve would be drawn. Same, the total variable cost begin from the origin, keep on upward sloping, and that cuts to the total fixed cost, and that curve becomes the total variable cost. So the summation of the total cost, the summation of the total variable cost and total fixed cost becomes the total cost. So the gap between the total variable cost and total fixed cost, the gap would be the total fixed cost. So the gap between the total cost and total variable cost would be the total fixed cost. So the relationship in terms shown in terms of four main points. The total cost is divided into two parts: total fixed cost and total variable cost. And mathematically, we just adding up these two costs, it becomes the total cost. Total fixed cost is an overhead cost, and it remains constant and fixed whether or whatever the level of output would be incurred. So total fixed cost curve is a horizontal line and parallel to the x-axis. So it doesn't matter whatever the cost would be, but the output would remains the, you can say, keeps on changing or whatever the level of output, but the cost would remains the same. Total variable cost is a cost due to an increased use of the variable factors of production like raw material, labor, any sort of utilities. And that's why TVC is an inverse S shape starting from the origin just to a law of variable proportion. Total cost is an aggregate of the TFC and TBC. So the total cost curve is an inverse S shape starting from the level of output of the fixed cost. And the reason behind is also the shape of the shape of such total cost would be the law of variable proportion. As we increase to produce more and more output, we need to add on the additional units of output. And as a result, due to add on the units of output, the cost will also become higher to higher. And that's why total cost curve becomes, you can say, inverse S shape, and of course it due to an increase into a level of output as the cost becomes increases. So this is how the relationship between the total cost, total fixed cost, and the total variable cost will be shown through the diagrammatic presentation by following up the explanation which has been given in these four main points, and which reflects the relationship between the total cost, total variable cost, and total fixed cost. That's it for today. Thank you so much for listening this lecture. I will come up to the more and more important and relevant topics in the upcoming session. So till time, thank you and namaste to all.